Alright, today we have something a bit different. We're actually going to be looking at my worst trade of 2026, at least so far, but hopefully for the rest of the year, and that is QXO, with the same ticker symbol as well, QXO. So essentially in this presentation, I guess, video, we're going to be looking at what happened, where my model broke, and then a new fair value price target I now have for the stock. You can kind of see the headline here. The stock peaked around $25 a share, but now it's down around 42% year to date. So in terms of the damage then, the entry price I originally had for the stock was around $20 a share. I think our dollar cost average initially down to like around $18 a share. Although as of today, or as of the writing of this presentation, the stock fell down to $14 a share, and since then I think it's gone down even further now to around $13.50, I think. So yes, had a massive drop. And then the old sell price target then I had in my initial analysis was around $36 a share, in terms of the ideal price I'd like to sell at in terms of present value, which we'll get onto when I talk about the fair value price targets. But you can kind of see a massive deviation then with my new fair value price target of $17 a share, and then the accumulate zone, which is roughly around the price I'd buy more shares in the company, which is under $12.50, which again we'll get onto. In terms of what happened then, I'd effectively say there was like four forces that hit at the same time, and that kind of exacerbated the whole downside and all the issues, and it all kind of came all rolling at once, which tends to always be the case. But effectively then, the first point was the fundamentals deteriorated, where the Q1 sales for 2026 were actually down quarter over quarter compared to last year, around $200 million, and the adjusted EBITDA was only $1.2 million, not billion, 1.2 million, which represented a 0.1% margin. And the reason for this then was soft R&R demand, benign storms, and then rate constrained construction. And I think that's the big one, right? Coming into 2026, I was pretty much expect interest rates to fall. Obviously, we had 2025 with the trade and tariff wars, which kind of prolonged the interest rate cuts. But going into 2026, I thought, the economy would hopefully start to get much better, be much stronger, which would then lead to some more rate cuts. Of course, that didn't happen, especially with the Iran war that then happened in February. I think was it now February, March now, I believe, which increased energy prices, and that of course has meant no rate cuts and even rumours and put the possibility of interest rate hikes. The second point is actually a mechanical issue when it comes to trading and the stock market. It's not really a fundamental issue with the company, but effectively what we saw was the recent acquisition of Top Build, where the company handed 312 million new shares to holders who actually preferred cash and voted for cash, which we'll get onto in a bit in terms of more of the details with the acquisition. But effectively what this then meant was 312 million new shares of QXO were issued into the market, given to shareholders who pretty much didn't actually want those shares and they just wanted cash. The third point then is dilution, and this is the one I didn't forecast properly, and I should have forecasted much better. And I think it's where basically I rushed the analysis and was being a bit lazy, if I'm being honest, compared to my usual in-depth analysis I do. So I don't think it's any surprise that my worst trade of 2026, and probably my worst trade in about 2-3 years, has come from a stock that I've entered where I've kind of been a bit lazy, cut some corners, and didn't do the full in-depth analysis. And that is, like I mentioned, dilution. So common share count, as you can see here, within literally a year has gone from 680 million to over 1 billion shares in issue. And I think one of the future slides will kind of break that down and talk about that a bit more. But as you would expect with share dilution, the value per share that each shareholder, the percentage that every shareholder has a claim to all the top line revenue and the earnings, of course, decreases, more slices in the pie. And then the fourth point is kind of again linked to dilution, but of course with the company being so heavy with mergers and acquisitions and getting so many acquisitions on board, they're either funding that by diluting shareholders via equity and capital raises, or they're doing that by leveraging the company up on further debt and increasing, the debt leveraging of the company. So in terms of the wall of selling then and the Top Build flow back. You kind of see here that the deal was around $505 a share, or around 20.2 QXO shares per BLD shares, and it was capped at 45% cash. And the big tell here was the fact that top build holders elected for cash 91%, so super high. Pretty much nearly every single top build shareholder wanted cash rather than QXO shares, and in the end what they got was 10.2 QXO shares and $249 of cash, which then of course, as I mentioned, left an overhang of around 312 million new shares in issue given to people who pretty much didn't want it, and that represents around 30% of the total share count, and it was handed out on the 1st of July. Of course, the silver lining here though is the fact that this is a technical decline and not a fundamental decline in the actual business. It's more of a mechanical thing regarding stock market, equity flows, those kind of things, and it can be reversed, although it will take weeks, more likely months rather than days, right? So we're going to see, at least for the next few months, a flood of selling. On top of the fact then there's of course merger arb shorts who will again press their tape because they know there's going to be this flood of selling, so they're then also going to be selling and shorting the stock. Effectively adds a lot of sell pressure to the stock, which, if I had to guess, there's pretty much very small percentage chance that the stock has any significant price appreciation for the rest of the year. Maybe like around Christmas time, I don't know, we'll see. But definitely, I think for the rest of the year, we're very unlikely to see any significant gains in the price. But in terms of where my model really broke, then it was just a denominator error, like I've previously mentioned, where I didn't forecast properly the share dilution when I did my modeling, my very bare bones and quick modeling, to be fair. And you kind of see the heuristics I used here then. Effectively, that management targeted around $50 billion of revenue within the next decade, which they still are guiding for and it's still expecting. And with a distribution business trade like this, then we can very easily see a 1x sales multiple. Sometimes you can see even higher than that, especially when the profitability and the EBITDA are higher than usual, which I also did think was going to be the case, and I still do think will actually be the case given Brad Jacobs' track record of increasing the efficiency and leanness of businesses and the profitability of companies. I do think that still will be the case. However, just for simplicity's sake, a 1x sales multiple then of $50 billion of revenue implied a market cap of $50 billion, and given the valuation around the time was around $12 to $17 billion, you can kind of see here a so-called easy multi-bagger opportunity, which was where the fair price target earlier came from. But of course, the flaw then with this was the $40 billion is being bought with shares and dilution, whereas I thought it was either going to be funded via free cash flow from the original businesses that they had acquired. So over time, use that free cash flow to then acquire other companies and build naturally from that. And then on top of that, utilizing cheap debt and leveraging to acquire more companies. So you can kind of see here the revenue per share grows far more slowly than revenue when you have a lot of high share dilution. So that means QXO can hit $50 billion in sales, but then still deliver mediocre outcomes for anyone who bought around $20 a share. And I think the permanent lesson here then, as I've mentioned, is before underwriting any roll up on revenue or EBITDA targets and assigning any multiples to revenue or earnings, you need to force the question of who funds the growth and what does the fully diluted share count look like when the target is hit. And so here we have the real share count breakdown then. As I mentioned before, it had around 680 million of common stock outstanding, and now it's over 1 billion shares outstanding. And then on top of that, then we have further dilution via the convertible preferred shares, and so the fully diluted share count is actually 1.43 billion shares in issue. And then further to that, they've also have Series C convertible shares, which convert at $23.25 a share. So currently out of the money at the moment as of today. But then, yeah, if we were to get back to around $23 a share, there's another wall of shares that would hit, which is around 129 million. In terms of the fully diluted equity then, like I said, the $14.58 share price, which again has gone down, but we'll use that as of the writing of this presentation, with the 1.43 billion shares in issue, gives fully diluted equity then of around $20.9 billion. You have net debt of $8.2 billion, the Series C preferred, which is stated at $3 billion, and then that gives an enterprise value then of $32 billion. So you can kind of see here already the enterprise value of the company in 2026, before they're anywhere near the $50 billion in revenue, is already kind of creeping up there and already getting pretty close to that $50 billion I had in 1x sales multiples. On top of that, then, if you also look at the EV, so enterprise value to EBITDA multiple, it's currently 16, which is again still the highest out of their main peers and competitors. Even with the stock price crashing as much as it has, down to 14.58, it still actually has the highest EV to EBITDA multiple in the sector. Although, as I said, as of the recording, I think it's gone down to around $13.50 a share. So maybe it's kind of in line with what QXO and Pool Corp now. Not 100% sure, but you can kind of gauge that there's still very highly premium stock, even though the stock price has tanked 40%. And that, for me personally, is one of the big reasons why I'm not accumulating more shares and dollar cost averaging down at these prices. I think the risk to reward still is kind of skewed quite poorly, which of course then leads us to rebuilding the valuation, utilizing the 2030 scenario where management have guided $4 billion in adjusted EBITDA, which then gives us our base case scenario, 50% probability. The bull case probability of 25%. Has an EBITDA of $5 billion, which again management have kind of hinted and guided at, especially Brad Jacobs. So that is also a possibility. We do see around $5 billion EBITDA generated by 2030. And then the bear case, we have $2.6 billion, which was from my previous DCF model. We've then assigned the EV to EBITDA valuation multiples. So for the bear case scenario, 9x, base case 12.5x, which has come from Ferguson, and so kind of been a bit prudent on the lower end. And then the bull case, we've given a 15x, which is again the higher two entities in the sector. Net debt then, as you can see, we've forecasted that out, utilized in the model, gone a bit more in depth. And then the fully diluted share count in the base case around 1.55 billion, which you could argue is actually quite maybe a bit low, although again management have indicated the 4 billion EBITDA target is, I believe, based on current equity and capital structure. So if they do further dilution but then don't raise guidance above the 4 billion, of course then the share prices you're seeing here will be even lower. As far as I know, the current capital structure and equity of the company is forecasted to now generate $4 billion in EBITDA by 2030. This then gives the 2030 share price value then of $27 a share. And then present value then, discounted at 10%, gives a value of $17.50. Of course, in the bull case, you have $27.25, and in the bear case, $5.90. Probability weighted then is pretty much, again, as you'd expect, $17, given the fact that we have most of the probability weighted towards the base case. So of course, $17 probability weighted PV indicates a 20% upside then from the $14.50 current share price. Again, for me, I personally want at least 40% upside, given the risk to reward has been definitely skewed against me. And again, if I was to dollar cost average down, I'd want to be getting a really good price now. Otherwise, I'm more happy to kind of ride it out, be a bag holder for these next maybe year or so, maybe even 2 years, while the company kind of sorts itself out, and just leave the shares in the portfolio just sitting there. And then if the stock was to go above 20, maybe go around the bull case present value target around $25, $27, then I'd probably look to sell and kind of get rid of the position. So the verdict then, was the crash justified? Of course, I think in this case, sometimes when you have your worst trades, you think the market's against you and you don't think it's anything to do with yourself. That I definitely don't think is the case here. I think it was a complete miscalculation. Of course, there was some technical and mechanical issues given the flowbacks with the acquisition of Top Build, where there's just a wall of selling, nothing you can do about stuff like that. You could argue maybe management should have done a full cash offer, although again, as a shareholder, would I have wanted to see them spend all their cash on the acquisition? Probably not. But I think the big issue, as I mentioned, was a share dilution and not forecasting that properly. I think getting a bit ahead of myself, expecting an easy multi-bagger based on sales and upcoming EBITDA without factoring in the denominator in that equation. It would have been nice if I'd done this valuation 6 months ago and realised this. So then instead of buying at $20, $18 a share, I could have waited until now to start accumulating shares at 14. But of course, hindsight is always the case there. All right, cool. I'll leave it there. Again, if you have any questions, leave them down below in the comments. Otherwise, yeah, I'll see you guys in the next one.